your papers, I realized that some of you face exactly the problem that all of us face when abruptly we start solving some of the modeling problems. So, where to close the bracket, where to just put the comma, and all those things are like, if you're practicing, you know exactly that after transport, there no need to start the brackets. But some of you have done it, and because of that, the answer that you have got is different than the answer that you should have got. So the variance covariance problem of the question number two, around 10% of you have done it incorrectly. Why? Because there was no need to put extra bracket, and you, since you put the bracket, so, and some of you have divided it by 11 rather than 10, because there are 11 data from 1982 to 92. So the 11 years. But as you know, like when you are given a sample data, you have to divide the numerator by n minus 1, not by n. So this is what happened. So that's how. But okay, I will share, and then like you can get to see that. So okay, let's start, because I think whosoever had to come, they have come, and rest of you are there. So we'll start today with our binomial from where we left. So can you see this slide on your screen? Hello. Hello, can you see
Yes,
this?
sir, we can see.
Yeah, yeah. So because otherwise, what happens if I keep talking and you are not listening? Then ultimately we'll be lost. Yeah. So we stopped here where I solved for the put price and call price using the something called uh, arbitrage way, like where I showed you that if I buy a stock, a number of stocks, and I buy b number of bonds, so in the up state I should get the same price, same return as a call option is giving, and the down state I should get the same zero return as it is happening in the case of a stock and bond. And then we solved for a and b, and then finally we got the price of call option and put option. That was at the very basic level of solving call and put prices in a situation like this. But because we are doing modeling, and we will be using a sophisticated software called Microsoft Excel, so we don't need to do that way. Why? Because we will be solving very complex binomial lattices, and those there you'll find it difficult, because if the moment you have two, three lattices, uh, it's going to be difficult. So how we do in Excel actually is we uh, we assume there are two factors like Q U and QD. QEU is the price of $1 of stock in up movement. So QU is if the stock goes up, if the actual price is $1, we price it by QU. If the stock goes down, we price it by QD. So let me show you the latest. Yeah. So if yeah, here it is. So the 55 is if the up price, and 48.5 is the down price, where the stock is going down by 3%. So in the up state we are pricing $1, we are pricing for QU. In the down state we are pricing QD. So this is how we'll be doing, and you will become very familiar with it as we progress. So just bear with me. So two things: if the stock price is $1, the we assume that at day zero it is priced at QU. At day zero, if the stock is going to go down in the next period, we price it at QD. So actually, when a stock goes up, the actual price will be QU into S into U, and if the stock goes down, the price will be QD into S into D. Why? Because we are pricing the option at QU, assuming that a stock is going to be up. But if it goes up, its price will be S into U. So S is the actual price from where we started. U is the up movement, which is 10%. But we, because we are pricing by QU, a factor, so actual price when it is in up state is QU into S into U, which is what this particular thing is showing. Similar way, we can price in the down when a stock goes down, we can price that uh, uh, option by QD into S into D. So basically, we have two different prices: one in up, QU into S into U; one in down, which is QU T into S into D. Now, by a simple formula of arbitrage, or principle of arbitrage, if we sum these two things, which is what is being shown here, this should be equal to S. S. Why? Because if they are not equal to S, then you are not pricing it rightly, and then there is arbitrage opportunities available. So we are pricing QU and QD in such a way that whether it goes up or goes down, the fair value of the both the upper state and the down state should be S. So if I eliminate S, then this becomes QU into U plus QD into D equals 1. This equation, if I take the S on the left side, so both on the left and right side there are S available, that they get cancelled. So what remains is QU into U plus QD into D equals 1. So this is one of our equation which is very valuable. Now, next comes this particular equation, which is QU into R plus QD into R equals 1. Now, you may ask me, how come this equation? So, just go, let's go up in the this state, yeah. So, this is the bond. This is the bond, and this bond goes up or bond goes down. Either way, we are going to get the same amount of money, which is 6% rate of return, which is what we have assumed. But we are pricing this bond in the same up state and down state. So what this equation is telling you, that if I price bond in up state at QE with the price bond in down state at QD, and you multiply by R, because it's going to be giving you return 1 plus R, which is actually R in our equation. So the sum of this value should be 1. If it is not, then we have not priced it perfectly. So these two equations, basically, these two equations are the cornerstone of or the founding stone of the option pricing model in our case. So QU into U plus QD into D equals 1, and Q into R plus QD into R equals 1. Why? Because the 1 rupee is the price of bond from where we are going to get 1 plus the R return, which is how we are pricing this. So from these two equations, if we solve this linear equation, what we get is QU equals R minus D upon R under bracket U minus D, and QD equals U minus R upon R U minus T. Denominator is the same, only numerator is the different. So this can just be solved with the help of these two equations. Now, here and after, you just need to memorize the two. If you memorize these two values of QU and QD, which is the price of the option in up state and price of the stock in the down state, these two, then you are done with almost 95% of the model. So all you need to do is to memorize QU and QD. Now, there is something which is not mentioned here, which I want you to remember also, because if you don't remember this, then someone might ask you this in your interview, and probably you will cut a sorry figure by just like talking about modeling, but you may not know about the background of why this is happening and what are the requirements of this to happen. So let me enlarge it and then show it to you. Yeah. So one of the conditions required for this binomial modeling, which is what we are doing, is the up state should be greater than the risk-free rate, 1 plus R, and that should be greater than the downside movement. So you cannot have a situation in binomial model where if the interest rate is 6%, your downside is 7% and your upside is 10%. That's a not desirable situation, and your binomial model cannot solve for that kind of situation. So it's very important that the rate of interest which is prevailing in the market is in between the up and the downside movement of the stock. So so the up here, as you can see, is 10%. intercept is 6%, and downside is 3%. So definitely, as you can see, is U is greater than R, and R is greater than D. So this is the very important condition for the model to hold. If this condition is not there, you cannot model anything on the binomial option pricing model. So this just you remember. Now that we have solved for QU and QD, so let's calculate what is QU. So as you can see, the QU is nothing but R minus D. So where is our R? R is this. And then where is D? This is D. Then R. U minus D. Yeah, one more bracket is required. Yes, okay. So as you can see, the value of QU I got is exactly what should be the value on the left. So the textbook value and our value matches. Now coming to QT, which is very simple, but again we'll solve it because this is the first time we are doing it. So in case of QD, what we do is we subtract Q minus R. So this is up minus the intercept factor divided by, I will do U minus R. So I save on this U minus D, save on this step, then I divide by R. So I think there is some mistake here. So U minus D. And then we are done. Oh, why is this B 100? 102, 102 B 100 minus 101. So why is this different? Mhm. Yes. Yeah. So there was a mistake. Actually, what happens, that's what you should also be careful about. If you put unnecessary bracket, then Excel sometimes understands that this is going to be numerator or denominator. So you should be careful where you are dividing, where you're multiplying. And that's why proper use of brackets are important. So that's why I thought that I should do it, even if we know the answer, but we should do it. So this is QE and QD. So why practice is important, and which is why I emphasized in case of your paper, which you solved, that those of you who had been practicing well, it was very easy for you because it would have taken just 30 minutes or even less to solve all the four questions. But those of you who were not practicing properly, for example, some of you wrote in those papers that formula not working, and it's a very funny that like how is it that formula is not working, because it was working for others and it was not working. The reason is you don't practice, so you don't know where are the problems. So for example, here if we don't put one extra brackets because we started with one bracket, So it understands that as if that the next factor which is going to multiply by the whole factor, and that's where there are problems. Now there is one more thing that we need to do. So you have to check whether QD into QD is the price uh, in the down state, and QU is the price in the up state. And if they are multiplied with both down and up state, they should be equal to 1. They should be equal to 1. Now you might ask why, how come, and what is the relevance of this? So I will show you. First, let's check this is happening or not happening. Then I will tell you why this is. So this is QD, and then I have to multiply this with D, actual D plus QU, and then I have to multiply this with actual U, and let's see what is. So it came as 1. And also the second factor, which is QD into R plus QU into R equals 1. So they are equal to 1. So for our when we started with the assumptions, the QU into U plus QD into D equals 1, and QU into R plus QD into R equals 1. Now I was telling you that why this is important, though we are pricing bond 1 in the state 0, in the sense that we are pricing it in such a way that if it goes up, its price becomes QE into R. If it goes down, price becomes QD into R. And in each case, we should be pricing it perfectly. But actually, there is more to it than just what we stated. So this QD into D and QE into U is nothing but risk neutral probability of going up and going down, which is what we call pi U and pi D. So about that, I will yeah. So when we come back here, I will explain to you. Let's go in one by one. So now that you know this price of QU and price of QD, how do you price call option and put option? We have just priced QU and QD, but we haven't priced C and P. So to price C and P, we need to remember this formula and just this much, and then we are 100% done for our binomial option pricing. Hereinafter, we will only be using QU, QD, and C and P according to this formula. So C according to this formula is nothing but QU into maximum of stock into the up movement and minus exercise price, which is always the case that the option returns you the maximum value between the stock price at horizon, and subtract from that the exercise price or 0 at least. And then the second component is QD into maximum stock into the downside movement, and subtract from that the exercise price in case there is anything left in this. Similar way to for put option. In put option, we multiply QU into maximum, and we reverse this sequence. We subtract from exercise the stock up movement, and then add the QD and with the maximum value of exercise into a stock in the downside, and S into D, which is what we call S into D. So this formula you need to memorize, and this QU and QD anyway you know how to do. So I have written here that this is what you need to memorize. If you memorize this, then you are perfectly done for this. So now we are going to solve a problem, and problem is the same which we what discussed. In up movement, the stock goes up by 10%, so the U becomes 1.1. The stock goes down by 3%, so D becomes 0.97. Interest rate is 6%, so R becomes 1.06. Initial stock price is S, which is 50, and option exercise price also is 50. So these 5 parameters of options, these five inputs of options, we are going to use. This is QU and QD. I'm not going to solve it again because we have already solved it here. So let's save time by that. So now the QD is also there. Now the challenge is to solve for the call price. So how do I solve for the call price? So as you know, in call price, we need to take QU into maximum of what? Stock price, which is this 50 into up movement, which is this. From here, I have to subtract the exercise price and then also write 0 in case my assumptions are bad about the up movement, plus QD, which is this one, into maximum of stock price into downside movement minus exercise price and then 0, because it should not, this is most likely going to be negative. So then my value comes exactly what is expected of this. So 3.26 becomes the call price, and the put price against either you can do using call or put put call parity, or if you want to use the uh, QU and QD function. So QU into maximum. Here we use exercise first minus stock into up movement or 0, because we should not be using negative value because there is no negative, and then QD to maximum of size price again, which is 50 here, minus stock price into the downside movement, because this time we are going to the other direction, and I take this value and I enter, and I got the put option price as 0.4354, which is close to 0.44. So 3.265 is the call option price, and 0.44 is put option price. Now let's move to this side. Now that we have solved for call and put option, so the XU is the value of the option in up movement, and XD is the value of the option in down movement. So we have priced it saying that if the QU is the price of $1 in the up movement, so if I multiply with the XU, I should be able to price the uh, the uh, the, uh, mm, the stock in this up movement QU XU. If XD is the value of the option in the downside, so QD and XD is going to be the price for that. And if I sum them up, sum them together, that should be their uh, fair valuation for this stock, assuming that they are going to be XU and XD in the two states. Now here something different is there, and that's why I wanted you to focus here. Now let's assume that the stock goes up in up state as XU, stock goes down in down state at XD, but the probability of stock going up is pi U, and probability going stock going down is pi D. So if I have to I have to calculate the expected value, then the expected value of this XU and XD will be pi U into XU, which is the first one, and pi D into XD, because the probability, as this is what you have learned in your statistics, that if there are two, if a variable has two prices or two values, and the probability is P1 and P2, so we multiply P1 into X1 and P2 into X2, and that becomes the expected value. So the expected value of this stock when it goes up XU and goes down XD is pi U XU plus pi D XD. Now this is the expected value in this state, but because we are looking one state back, like in state 0, we are looking at it, and we are pricing in today when the stock is likely to go the next stage or state. So one period before we are pricing, so we are discounting it. That's how you do in financial market. All the valuation. So the valuation going to be pi U XU plus pi D XD, which is the fair value going to be after one period. But because we need to discount it, so that's why we have written pi U into XU plus pi D into XD upon 1 plus 1. So exactly, rather than doing this much, what we do pi u xu plus qu xu plus qd xd is what actually we are doing, and then you will understand that what we are doing is slightly different from the risk neutral prices way of pricing option. So we use estate prices, and estate prices is nothing but QE and QD. So just remember, we will be pricing everything with the help of estate prices, QU, QD, not by you, because if you have been taught options, futures and options, many textbook also solve for pi u and pi d, and then the discount for later on by the interest rate, because ultimately the prices tomorrow can should be discounted today at the prevailing rate of interest. So this solve for our purpose. Now the next thing that you need to do, once you have these call option and put option prices, just for the sake of like extreme caution, you should check whether put call parity is holding or not. So the first side of the put call parity is a stock plus put. So stock is 50 and put price is this. So I enter and it becomes 50.43. And check for call plus present value of, so what is call this, and plus present value of x. So what is present value of x? So x divided by 1 plus r. And this is also giving you the same value. So we are convinced that the model we have used is the right one, and the equations are also working well, because we have not missed on something. So the put call parity is also holding. So so this is how we solve for call option and put option pricing. One thing to remember here is, what we are doing is basically European call and European put. We have not solved for American call and American put, which we'll be doing later. But let's take, before we solve for that, let's take it to multi-period binomial model. So this time we were doing one period binomial model, in the sense that the stock was going to be X or Y in the next period, and we were pricing it today at date 0. Now, assuming that there are two periods. So, for example, let's say you have 2 months time. So you are in April and you are looking at June price or something. So it's possible that in May also price will be different, and in June also price will be different. So you will have two periods. If you take quarterly, so if you look at now, so you can have 2 quarters further. So you can have September quarter also, you can have the December quarter also, and you can look at prices at two different places. So that's why in binomial it's important that you should be having as longer a horizon as possible, then for the model to converge to Black-Scholes option pricing model, because the longer the horizon you have, the longer number of periods you have, chances that the model price will come very close to the real price. So here we are going to solve for the two periods. So the condition one is the same. Stock goes up by 10%. So U becomes 1.1. Let me write it here. U. Stock goes down by 3%. So D becomes 0.97. And interest rate is 6%. So this becomes my R. 1.06 is my. So basically QU and QD remains the same. I'm not going to solve it again, because as you know, they can be easily solved with the help of formula. Which is that you learned, R minus D upon R into U minus D, and U minus R upon R U minus T. These are the two formula that you will be using. I have written also here in formula section. I will be sharing it afterwards, because there are some additions which you need to know. So I'll share it after it is done. So now come back to the dates. So we are pricing this European call option at date 0, but there are two stages and two dates. So when the stock goes up, it becomes 55, and if it goes further up, it becomes 60.5. If it goes up and goes down, it becomes 53.35. If it goes down and goes up, it becomes 53.35. If it goes down and further down, it becomes 47.0450. On the other hand, in case of bond, Rupee 1 becomes 1.06 in next period, and it becomes 1.1236 in next period, irrespective of the paths that the stock takes. Stock, whether it goes up or goes down, remains the same, but bond prices will invariably be giving you these two returns, 1.06 in at date 1 and 1.1236 at date 2. Now coming to this, you might ask that how come this 60.5? So 60.5 is nothing if you is 50, which is a stock price, into 1.1, which is the second state price, into 1.1. So it goes up and up, so it becomes 60.5. 53.5 is nothing but 50 into, if it goes up, so 1.1, and if it goes down, so 0.97, and then it is 53.35. 47.0, this can also be done in a different way. So if I assume that it goes down and it goes up, the same thing. 47.045, how we get this price? So this price is 50 into 0.97 into 0.97, because this is only possible if the stock goes down and down. So 47.045. How did we get 1.4? So this is just this a square of 1.06 into 1.06. So this becomes 1.1236. Now calculating call option prices in these two states. So remember, we are calculating call option price in European way. We are pricing European call. We are not pricing American call. Of course, you will see sooner that there is not going to be any difference between European call and American call. But of course, there is going to be difference between American put and European put. So what happens is, this is the price of the call option, 5.7492. Price in the upper state, price in down state, and this. So how come this 10.5? So 10.5 is nothing but this 60.5 minus stock stock price of 50, or exercise price of 50. Okay. Then 3.35. How come it comes? This comes from this 53.35 minus 50. And then, as you can see, the zero value is there because this is less than 50, so there is no value in this case. Similarly, here, as you can see, this is 55 and 48, but we are pricing at 7.8302 and 2.18. So how come we are pricing it differently than the maximum price of the option, which is here, it's 5. So just see. So what is happening is, like 10.5 and 3.35 are the two prices. So we'll again use QU and QD. So equals, what is QU? So QU is this into maximum of 60.5, which is what it is here, minus a stock price of 50 or 0 plus 2D into maximum of stock price in this state, which is 53.5 minus 50 or 0, and then we get 7.8001. Okay. Similar way, at the bottom middle node, we use the same QU. So this is QU into maximum of bottom. There are two prices, 53.35 and this. So we'll take 53.35 minus, we could have taken S into U into D, but because we know the price, so we are taking, I'm taking it like this, minus the stock price of, exercise price of 50, or 0 plus QD, which is again this one, into maximum of. So in downside, you have the 0 as a price. So 0 minus 50 or 0. So you're not going to get any value, but still we'll write like this. So this becomes 2.18. So the call option price at these two at the middle node is 7.8302 and 2.1880. With these two prices in the middle, what should be the
Excuse me,
price?
sir.
Yeah.
So could you zoom in from the bottom right for a while? Thank you, sir.
Is it better now?
Yes, sir.
Okay. So yeah, so we got these two prices at the middle node. Now we need to price at the date 0. So again, you'll use the same QU into, so QU into maximum of. So you know that this value is going to be this. So there is no need to use maximum. So just write this value, because then you'll need to know the whole value, plus QD, which is this one, and into, and then you got the value. So price at day 0, is 5.749166. If there are two periods, or and we are pricing at today day 0 is 5.749166. So this is how you will price if there are two period of binomial models. Now I need to give you some words of wisdom, so that will be useful when you uh, pass from college and you are still doing something relevant, whether in the industry or somewhere. This pricing that you're seeing, where do you actually use? Because nowadays Black-Scholes option pricing models are inbuilt in almost all the software. All you need to do is to input stock price, exercise price, interest rate, volatility, and that's it. And the time period, like 1 month or 2 months, whatever is there, which is always implied because it's visible on the screen. So the software solves for you the ideal value of the call option or put option, and then the trader takes a call whether to buy it, sell it, or not to get into this, depending on the situation. What about the binomial pricing model? So I have seen that if you have a good understanding of the geopolitics, good understanding of the oil market, which is what OPEC is into, and the non-OPEC like Russia, they're into, then you can price uh, the options embedded in oil price today, depending on these situations. So how this can be done is, so the oil production of the world is almost constant on a daily basis or on a yearly basis. However, it fluctuates depending on the situation. So for example, the war is going on between Ukraine and Russia. So Russian production is stopped for various reasons. The production is not as it at its peak. Some production, I'm sure, must be happening, and India is one of the buyers. But Russia, at its peak, was pumping 10 million barrels of oil a day. So the overall, the global oil production per day is around 75 to 80 million barrel per day. So the future and options of them is 10 to 12 times higher. So obviously, one thing is very sure: if by any chance one nation disturbs the oil production, the supply becomes less and demand becomes more. So prices definitely will get reflected. So, these two situations you can easily model that in case this doesn't happen, then the 10% or 12%. If this happens, for example, if tomorrow Russia comes into oil production and if everything becomes normal, then there will be oversupply of oil and the prices will fall back to normal. So this is how you can do it, and this actually works if you can do it. However, if like you are pricing for a very long duration, assuming that the first quarter dividend will be this, next quarter dividend of a stock will be this, and then if you're taking all those consideration earning per share, so you can do it for multi-period and still you can price it. So the bottom line is you can price if you have a fair understanding of the up state and down state, depending on the situation that is possible. Now we take the call price at multiple periods. By multiple periods, I mean not two, but it could be 4, 5, 7, 10, 20, 50, 100, and even more. So how do you price? So this becomes computationally challenging for us to solve the way we have been doing till now, because we can do this at most we can do up till here, because we can take the maximum value from the 60.5 as 10.5, 3.35, and 2.945 is what we sorry, 0 is here. So but if you keep doing this and keep valuing it, it becomes very cumbersome and becomes very difficult. So, is there a way out? The answer is yes. But let's see first how this is to be done. If at all we want to do it in the same way as we were doing. So, how do we get this price of 73.2? It's a very simple. The stock goes up, 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 up. So it goes 4 times up. So this becomes
So
50.
can we just take 1 minute break? Just 1 minute.
Yeah, sure.
Just to copy down everything.
Oh.
Sir, you can continue, sir.
Okay. So this the 73.20 price is nothing but 50, which has gone up 4 times. So this 1.1 is to power 4. So this is what price we have got. So for this 64.55 to reach 3 times, it should be up. So this equals 1.1 raised to power 3 into 50 into 0.97. So there is some mistake. 1.1 raised to 4. Oh, I see. So 64.5. This is how we calculate the price at these nodes. So the today price can go up, and can go up and then down, up, down. All those things are possible. So we will be doing this jugglery for some time from now before finally using the VBA for this. But before that, we need to understand that how the formula actually works. So we need to know this. So okay. So but in case of bond, as you know, if you keep 1 rupee in your account, in the next period will be 1.06, in the next period will be 1.12, 1.19, and 1.26. So bond will continue to grow irrespective of the prices in the stock. And this is why when you do portfolio management, like as you did in case of optimal allocation to portfolio, you always select some amount of risk-free rate. Why? Because even if the stock doesn't perform, your risk-free is performing, and then your risk return metric, you are better off. So okay, so coming back here, yeah. So moving on, how do we price this, the call price in this kind of period? So this is very simple. As you know, this 23.2050 is coming because of the difference between the exercise price and the stock price in that state, so, which is 73.20, and the stock exercise price is 50. So we are subtracting it. But how come 19.38 has come? So again, this is simple, but we'll solve it once. So it's coming because of QU into this price of 23.20 plus Q. So we'll write 23.2050 into this QU is 0.65. Yeah. So this is 0.653 plus B149 into 14.5535. You got exactly the price at this node. So how you price this is we take the estate price QU and multiply with this, and we take estate price QD, multiply with this, and then we get this. And as I told you, it has to be this, otherwise there will be arbitrage, and one price will be different than other, so traders can make money on that. So this is how we do. And again, this 16.02 can be calculated as the prices of these two. 8.8502 can be calculated as prices of these two values, and 3.02 can be priced as this, and finally we come back to this 10.043. But do you really have to price everything backward? Because if you keep doing this, this is really going to be very cumbersome, and in the age of computer, in the age of market, where every second the prices are just like moving like anything. By the time you spot any arbitrage opportunity or anything profitable, and if you keep doing like this, then the opportunity is gone, lost. You have just time for seconds before you implement something. So how we do it in this situation? So again, let's summarize the whole situation once again. So in the up state, the price is 10% up. In the down state, it's a 3% down. Interest is 6%. So 1 plus R is R becomes 1.06. The stock price is 50. Option price is 50. Option exercise price is 50, and there are 4 periods. So which is what we are considering it here. Period 1, 2, 3, 4. Date 1, 2, 3, and 4. So in 4 period we're running, which is a very good, robust pricing model if you are taking 4 periods into consideration. So there is nothing like this. So this is like almost as if like you are doing. So you can effectively, what you can do is, as we have done it here, if you keep doing this iteration, which is what I showed you, so then we'll come back to this, and finally we'll come back to 10.4360. But then this is really very challenging way of doing this. So how Excel does it actually? So if Excel has to do, so how Excel does it? So just look at this chart. I will teach you how to do it the fastest way possible. But before that, you need to pay attention to this. So number of up steps at terminal date. So if I just take all the up state, so this will be 4 because stock goes up in the first state, second state also it goes up, third state also it goes up, and fourth state goes up and goes to the pinnacle of the lattice where its value becomes 73 point something, and that's why the option becomes 73.20 becomes its value, and that's why the option becomes in the money and it has a good value for the pricing purposes. Now the next column that we prepare is number of steps down steps at the terminal. So if there are 4 steps at up, the down state can only be 0 because there is no way that like you can reach the pinnacle of the lattice by going down. So that's the only way. One. What is the price? Price is 73.205. Now, if a stock goes up 3 times continuously and then goes down by once, the stock price is terminal price 64.55, which is what you saw. Let me show you once again. So this is what you saw. If it goes up, and then finally goes down, this again goes down once, goes up, and goes up, then the same price. So either it goes down goes up 3 times and goes down once, or goes down once and goes up 3 times. The value is going to be the same, which is 64.55. Now, if there are 2 up states, so there definitely there will be 2 down states. So just a moment, someone is there. Yeah. So if the number of steps are only 2, then the down state will be 2 because there are 4 paths to reach to the final destination. If the up state is 1, then down state has to be 3 because then only you can reach the other direction of the terminal price, which is 50.19. If there are no up step, if the stock keeps going down, and 4 times, finally it will reach 44.26464, which is what we showed you. 44.2646 is only possible if the stock goes down, further down, and finally down. So the first top price and the bottom prices are only possible if the stock either just goes only up and only down. In between prices, it's possible that it can go up and go down depending on the path it traverses. But again, it's possible that it can reach any of these middle nodes. The 3 middle nodes that you are seeing can be attained by any of these paths. So if this is the situation, then what is the option payoff at terminal state? So option payoff at terminal state will be this price minus 50 is what we have taken the stock prices. Yeah. So 50. So I make it dollar. I can use F4 and it becomes dollar. So, and if I drag it down up till here, it gives me option payoff at terminal state. So I get the, here I'm not using it. Why? Because I know it's going to be 0. So I will use the function maximum and this minus the stock price or exercise price. Actually, I should have used exercise price or 0. And then I have got this zero price. So these are the option payoff if the stock goes up in this direction. Now the next thing that I need to do is the state price for terminal date, which is QU into QU into QU into QU, or if there are down QD, so then I have to use QD also. So it's not possible that I just use QU. So I have to use, so here what is happening is, what is QU? So as you know, QU is 0.65, and this is going to be 4 times. So I'll just use power 4, and I will get the value 0.182. So this is, in the second situation, the up movement is 3 times. So I will write this raised to power 3 into the QD. So I got 0.080, and here I again know that 2 times up and 2 times down. So this raised to power 2 into QD raised to power 2. Sorry. So I got 0.0359, and then in the fourth scenario, the down will be 3. So this raised to power 3 into the up will be 1. So this is my value. And the last stage only there will be down. So the QD raised to power 4. And then I'm done. Now the next thing that is important, is number of paths to terminal state. This is very, very important, and probably the most difficult part for you to memorize. So let me make it little bigger also. So here, this is a challenge to do. Why? Because this 43210, you know it very well that all can go 4 up, all can do all 0, no up, and in between 3 times up, 1 time down, 2 times up, 2 times down, 1 time up, 3 times down. So these and these are complementary. But what about this one? What about this one? So this is something that you need to either practice or either look at the lattice very clearly, and then you can see. So for example, as I told you, the number of paths to terminal state is only 1 in case you are taking all the upper state. The number of paths to the bottom of the lattice is only 1, because you have to, there is no way that you can go once up and then keep going down, you'll reach the bottom of the lattice. Bottom of the lattice you can only go by one way. But this going up 3 times and going down once, there are 4 ways of doing this. How? So let me show you. So I go up, I go up, I go up, and I go down. So this is one way. I go down, I go up, I go up, and go up. I reach the same place. I go up, I go up, I go down, and I go up. I go up, I go down, I go up, and go up. So like this, there are 4 ways, 4 different ways in which this price and this price can be reached. Similarly, this the middle price, if you see, the middle price can be reached by this and this, and these 2 can be reached by these 3, and which can be reached by these 2. So effectively, what is happening is middle prices can be reached in 6 number of ways. The top second and the bottom second can be reached in 4 ways. This can be reached only in one way, that is all top. So that's what we write here. So number of paths to terminal state is 1 for the top nodes, 1 for the bottom nodes, and the second one 4, and the similar ways 4 for the second bottom, and 6 for the middle one, because middle one can be reached by just going twice down, twice up, and then again in between also there are iterations. Now coming to the final step of ours. So this is nothing but the multiplication of this. So as you can see, this is the state price into path. Okay, so if you just a minute. So what is happening is the so value payoff is state price into number of paths and into the state price. So what is happening here? Here we are multiplying this, this, and finally we are getting this value. So this is important. So this into this and this path. So finally, if in case of this, I have to multiply this into this and into this, then I get this value. So this is how I keep doing for all the 5 different possible steps. And then what happens? I get these 5 values for this up state, down state, up state. So finally here I have to do nothing, but I have to sum it up. If I just sum it up, I get the option price. So I use auto sum, and then I've got the call price as 10.43604, and put price is anyway calculated. Now how did we calculate put price? So if you can see, if I can take my cursor here, okay, and show you, this is done by put call parity. So put call parity is nothing, call price plus exercise price discounted and minus the stock price. So this is how it is being done. So sorry. So you got the call price and the put price. Now the one thing which I wanted you to, and I told you in the beginning also, that what we are actually doing is, we are doing in case there are multi-periods, like there are 6 or 7 periods, 4, 5 periods, 6 periods are all possible. So we need to do things like this. But the question I asked you in the beginning, do you really have to price everything backward? The answer is no. But then what's the way out? The way out is something called the PVA model of the Excel pricing. So I will use call, not coming. So why is it not here? Or am I forgetting something? Just a minute. No, just just a minute. What, whether it is done here or not. I think it's done. That's why the prices are here. I'm using the same macro. Yes, I'm using the same macro. So oh, I'm forgetting the, yeah. So it is used binomial. I have to use binomial European. And then as you can see, the call is visible. And then here there is one catch. So if I use binomial European call here, which is what the it's a VB programmed here. Now your value should be in the similar order. If there is any slight change in this order, you will not get the answer. So your up should be first, down should be next, intercept should be third, stock price should be fourth, exercise price should be fifth, and the period should be fourth. So I will first select this one, then select second one, then select third one, then select fourth one, then select fifth one, and then finally I select the sixth thing, which is the number of periods, and I press enter, and I get the price, which is exactly the price that should be the price for the binomial European call. So I got the price of binomial European call. If I want to do pricing of binomial European put, I can also use. I select the second one, then I select first, second, third, fourth, fifth, sixth. Then I enter bracket and then I hit it. So then I got the call price and put price. So hereinafter, you will not be doing it this way. This is what I showed you, was just that to program it in this VBA, through VBA programming, we need to enter all this iteration, that if it goes up, if there are zero, then the terminal price minus this will be this price, and then the multiplication of this, and finally this value, then some, all those things are happening within the programmed file. So all you need to do hereinafter is to just remember that if you have multi-period call option and put option, 4 periods, 5 periods, 6, 10, 20, 100, 1000, all you need to know is whether the up is going to be 10%, 12%, down is going to be 3%, 4%, 5%, what is the interest rate. That's it. Stock price and exercise price, you know, because that's given in market. Number of periods you are assuming that you're pricing 1 year later or 2 years later or 5 years later. So all that you know is this. So most likely in the examination, if I ask you the call price and put price, European call or European put based on the 4 or 5 period, you should be having this macro enabled in your file, which you just copy and solve it. And I think you are perfectly okay, because in the modeling, I don't think you should be expected to do this calculation, because this is a very old way of approaching this problem. Why? Because by the time you do this, your competitors have already made money in the market. So what is the purpose of modeling if you are taking 20 minutes to solve a problem which is can just be solved in 5 seconds? So then this is how you will be doing henceforth, but you should know to reach here what was the methods used. So you are good if you can use these two things, and then you are fine with it. So now let's go and do the American put option. So as you know, the American put pricing is slightly different from European put pricing. The question you may ask is why. The reason is, if you remember, let me take you there when I did it the first call option pricing. Yeah, I think this was the situation. Uh, in fact, this is the situation. So, or was there a, yeah. So, so remember, this is 7.8302 and this is 2.188. But still the call price coming is 5.74. If I have the option to exercise it here, so I will anyway get 7.8. So why wait for this? In American option, exactly this is what happens. In American option, you can exercise any time in between. So any time means if I at any point of time you find prices profitable and you exercise it and you make money. But in case of European options, you cannot do it unless you wait for the maturity, and by the time you reach maturity, things would have turned against you, and that's why the pricing of American option is different from pricing of European option. So so for example, here, if the stock goes up, it U. If it go double up, it becomes U and U. If it goes up and goes down, it becomes UD. If it goes down and goes up, it becomes DU or UD. If it goes down and down, it becomes DD. So this is the situation. Now taking this to the lattice, so 50 becomes 55 and 48.5, which is what you saw. And then in the further up state, it becomes 60.50, 53.50, and 47.0450. Now, as you can see, the only value here is 2.9550. Why? Because the final price is less than exercise price, and a put option becomes only favorable if the final price is less than the exercise price. So 47 being less than 50, and that's why this has value, and this value is 0. Now to calculate these two, we can exactly use the same thing which we did in case of the QE and QD. So let's see. So as you can see, this is 0 and this is 0. So 0, 0. So this price is not going to 0 because you discount any factor, you use whatever discounting, you are not going to get anything more than this 0. But remember, in the down node, the one price is 0, one value is 0 because the stock goes 53.35, so put option becomes worthless. But when when the stock goes to 47.0450, the difference of 50 and 47.04 is 2.955. So the 2.955 is the value. So how do you calculate 1.5? So we calculate 1.5 in the same way as we did. So let's see. So the first one is QU into this 0. So obviously this is going to be 0. So I'm not interested in that. So I'm directly using QD. So into 2.955. Why did I get a different value? Can anyone tell me why did I get a different value than this 1.5? Is someone attending?
So
Here
can you
the
please
value,
show the formula?
yeah, yeah. Formula is shown here only because I think, okay. So formula is visible here. Let me enlarge it so that you can see it. Yeah. Can you see this?
Yes,
Here.
sir, but I
Yeah.
don't really know.
Uh, because if the price is if the value is 2.955 and 0, then if I use QE into this and QD into this, so it should come 1.5, but my value came as 0.8576. Am I wrong? The answer is no. I'm also right, but the mistake that I'm doing is I'm pricing on the basis of this and these two, assuming that the prices can only be exercised only at the expiry. But because this is a European one, so just remember, what is the price here? 47, 48.5, right? From 50, if it goes down by 97%, the price becomes 47.48.50, right? So 50 minus 48.50 is 1.5. So instead of 0.85776, I have taken it 1.5. Why? Because I can still exercise it 1.5 because this is European put option and this is where this is different from European put option. If this was European put option, the value would still be 0.85776. Why? Because even despite knowing that this is $1.5 or 1.5 rupee, I would not have been able to exercise. Why? Because I have to wait till this period to exercise it, and by then the value becomes uncertain. So here we take the maximum of the exercise price and this 48.5. So I get 1.5. And once you have this 0 and 1.5, so let's see what is the value. So QU into 0. So let me write it so that you don't forget, otherwise. So QU into this up price, which is 0, plus QD into this down price, and then I got the value of the European put option. Sorry, American put option. So can you see this? The price of this put option is 0.4354, which is different from the European put option you saw. If you go back and check, you'll find it. This is markedly different from the European put option. So this is how the European put option is different. And in case of European put option, uh, uh, as you can see, this is the value that I calculated. If you remember, this is the value that I calculated. The same value is calculated. And if this is the value and this is the value, then what should be the value? So let me calculate once again. What is the European put value? So it becomes QU, which is this into this value plus this value into QT. So I have multiplied this, the estate prices with the value of the option with the estate prices, and then I will press enter and see. So I got exactly the same value, which is the text value. This value and this value is the same. So this value is coming because of these are the two value at the node 1, and these are the three value at node 2. So node 2, these from these three value I get these two value, and from these two value I get this value, which is calculated this way. So you can see European put is price is 0.2489, whereas American same put is price at 0.4354. Why? Because in American put you have the choice to exercise at 1.5, which you cannot do in case of European put, and that's why the European put is. So there is a saying that American put is as much valuable as European put, but it could be more, and which is what is visible here. So that's how this is done. So now see American call option, how we price American call option in 2-period model. So again, like the same assumptions, the up state price is 10% up, down state price is 3% down, intercept is 6%, so R becomes 1.06, stock price is 50, exercise price is 50. QU, as you can see, is like calculated upon this uh, D minus R upon R into U minus D, U minus R upon R into U minus D. So these two are calculated, QE and QD as calculated. So the stock price from 50, it goes to 55, and then goes to 50.5, 60.5. If it goes down, it becomes 48.5. And if it can go up, then it can become 53.35 or 47 point, depending on which state is go up. Whereas in case of bond, as you can see, it can only go up, whether the stock price goes down or not. Now looking at American call option. So if 60.5 is the final, the market price of the stock, then 10.5 is the value, because 60.5 minus exercise 50. If 53.35 is the final price at state 2, then the value becomes 3.35, because 50 is the exercise price. And at 47.045, there is zero value, because this is less than 50, and because this is call option. So call option can only will only be available if the stock price goes up, further up than the exercise price. Now to price this, how do I price this? So let me. So I do this into QU. So I use QU for this. So let me go and take the QU price. Is this one plus I used it and used QT. Oh, that's okay. That's okay. So QT is this one, and then I get the up price, which is 7.83, and I got the same price here. Now it's 7.83 and 2.18 as the price. So how do I get the final price here? So again, I use the QU into up price. So this plus QD into the down price, or the value of the down node, and then I'm done. So I've got exactly the same value as the, so 5.7491 becomes the value of the American call option. So American call option is, like, as you can see, will have the same price as the European call option if you key in the. So you have these four prices. Up moment is 10%, down moment is 3%, interest rate is 6%, the stock price 50%, exercise price 50%, number of periods 2. Now, what is the price of American put? So you just write here binomial American put, which is the second one. So and then again, remember, you cannot select all at once. If you select all at once, the way you do for sum, you are not going to get any value. So remember, because in examination, you will have a tendency to select all that. And if you don't get by any chance the answer, then you will have a tendency to say that the Excel is not giving you the correct answer or binomial European put.
Sir, was this a macro or
Yes, yeah,
formula?
this is macro, because whenever you see underscore is not used the originally used in Excel. So anything which starts with underscore, it's a macro element. Okay, so
Sir, I had a query regarding macro. Can I ask you after the class?
yeah, no problem, no problem. If you have this with you, and then let's say if you change this period to 4 period also, so this will automatically change. So if I change this to 4 period, and if I enter, the value will change. See, the value is it's changed. So all you need to do is to have a sheet like this, which can give you a formula. Okay. Now coming to this, what is the price of American call? So binomial American call, so which is the first one only, and then I and I got it American call. Now if I have to get European call, so I have to use European call. Then again the same. And finally I got. So as you can see, the prices of American put and European put are different, but price of American call or European call are the same. So this is we come to uh, the uh, the end of this binomial option pricing in our Excel. So this is how we would be doing it. And in case you are given, so the only challenge for you will be, so next time when you are writing a paper, I'm just talking for the paper sake, for knowledge sake, all you, if you have this anytime, for example, if you make it 30, like let's say 30, all prices will change, and then you know for sure that what is the price. If you make it 1000, the prices will change. Okay, so what I'm saying is, oh, Excel has gone into memory serving. Okay, so yeah, so let's make it 2. So this is how. So all you need to memorize or to remember in your mind is that first you have to keep up value, then keep down value, then keep the interest rate, because you may not get the Excel uh, ready in your examination. You may have the macro enabled paper, but maybe all your value will be different. So so then just remember this order: the up, down, interest rate, initial stock price, option size, and the number of periods, and then you are done. So if all these three things are in order, then you can price whether it is American, European, American call or put option in case of American or European. So this is how it is to be done. So we are at the end of the call and put in case of binomial option pricing. We will move to black shows in the next session only, not today, because I need to tell you something about the Black-Scholes in the PPT format, so that like you can understand some of the things, some of the assumptions of the Black-Scholes, and what led to this famous invention of the Black-Scholes option pricing. So, uh, yeah. So till now, you have any question? Whatever, like you saw, you have any question up till now?
I have one regarding macro.
Yeah, yeah. Tell
So
me.
when we open a fresh Excel sheet,
Yeah,
we need to copy the macro. So I tried to Google it and then do it, but
yeah.
even after doing that, it is not being enabled. That is why I was getting errors. So
You are me here.
yes, sir. So that is why I could not solve the first question precisely.
Mean, I'm happy that you asked this question, uh, because after looking at your paper, I was little disappointed that you have been so forthcoming, and despite that, like somehow the paper you missed, you did the right kind of way to do this. But see that there is a problem when you see something on the net and you try doing it. What happens? The font size is used on the internet, and what is compatible with your Excel or what is compatible with your programming are sometimes not the same. So when you copy it and you paste it in your macro, what happens? The power function, when you use shift command and then the number key 6, it raises your power. But if you paste it from somewhere, it will show as E. It will show as E. Now your Excel is unable to understand that what you are trying to tell you. Now, if you go back and look at your the macros, it will show you in the red. So if it's showing you in the red, you should understand for sure that something is wrong in the way you have programmed it. Now, if you go by each iteration first. So, for example, like if I can show you here, uh, this one. So let me show you here. So this European call is not priced anywhere. Normally, you will not find this done in anywhere. Why? Because they know that European call is the same price as the American call if you've got it. But then this also I programmed it in the, the, this macro, because I knew that the at some point in time you may need to do it, and so this was all done, and this was giving error because again the problem is if you copy it from somewhere and paste it, something goes missing. And that's why this is very important. That's why while you are learning, you should understand that this what I showed to you, this is actually in the paths when files are programmed. So all these things are written in a very logical order, so they understand. And finally, what the model does is it solves for this, then finally sums for call, and then put option in prices using the put call parity. But then something is going on in the minds like this. So for example, like if a different language is spoken to you and you have to translate, so what you do, basically you take each word separately and you convert it, and then you say it. So the same thing here is happening in Excel. So nothing to worry. What you do is just look at your macro and see where are the red lines appearing, or the what's in the red is something. And if you find something which is not, for example, if you have looked at my programmed files in the VBA, you would have seen that invariably there will be up, there will be down, there will be brackets, and there will be things like this. So let me show you actually macro. So
Okay, sir, because I tried to solve the first sum, but I could not because it was getting continuous error, and it took me almost 20 minutes to find or
no, no. But tell me, first, second, and third didn't require any VBA use. They were all simple Excel. But why did you had problems?
no, sir.
First,
So the first one required that covariance variance matrix. No.
right, but that like we have told you four different ways to do. So covariance, variance matrix, and you in fact in the problem I have written it very clearly that you have to do it in a sample variance covariance method. Means like the sample is given, and from there you have to do variance covariance method. So I ideally should have. In fact, most of you have done it so well that I just looked at the one cell, and if I looked at that, you have subtracted the average from they transpose and then multiplied with the main matrix and the average, and that's it. Some of the places they have divided by 11, which is where I cut 1 mark, because you have to divide by 10, because if there are 11 rows, you have to multiply by 10, because it becomes a sample, and we are doing sample variance covariance, which is what the question is also telling me. So probably there also, if you are applying sim, which is not you're supposed to do, you should have used the sample variance covariances. So some of the you, and I felt very happy in case of some of you who did actually what. So first, from the return matrix, they subtracted the average, so they get another matrix, and that matrix they transposed, and then finally what they did, they multiplied transpose with the subtracted matrix one, and then divided by 10, and they got the perfect answer. So exactly this is how it should be done. But if you want to do it in one step, so you select the entire variance covariance matrix, and from there you subtract the mean return, and then multiply the transpose of the matrix with the original matrix subtracted from the mean, and then you get the answer. So that was the easiest thing to do. That was easiest thing to do. But probably maybe examination time and you are under stress, so it doesn't work. But I think that 95 to 99% of the candidates have done that right. And it's like, okay, so let me tell you the actual marks so that you know who has got how much. Just a minute, just please hold on. All right. Yeah. So sorry. So I was telling you about the marks that most of you have got. So yeah, like some of you have already left. And Himanshi, did I tell you about your marks?
Yes, sir.
Okay. And Jadip, did you know about your marks?
So you didn't tell me.
Acha, Himanshi, I didn't tell you about your
So you
marks.
didn't tell for anyone, actually.
Okay. So Himanshi, you got 15 out of 20. So you have not attempted question number 1, right?
So I attempted that. Maybe that was wrong.
Yeah, it was not at all done. But the rest 3 questions were perfectly all right. So you have done it almost good. The question number 1 is, I think, very easy, but I don't know why some of you missed. Probably, let me show you, because the uh, question number 1. So who has solved it properly? Okay. So Ayushi Rohtagi is there around?
No, so she's not here.
But this Sharanya was there, right?
Yes,
Sharanya was
sir.
there. Okay, you are still there. So let me show you. You have done it perfect way, but there is some mistake in your. But that's okay. So, like, what has happened in case of Sharanya? What Sharanya has done? Okay, I need to share it actually. Otherwise, uh, yeah. So Sharanya, I'm showing your Excel sheet. Is it okay?
Yes, sir.
Yeah. So this is question number 1 of Sharanya, which is like she has taken all the numbers, like these are name of companies listed in US. So what I gave was, let me make it even bigger. Yeah. So what has happened here is the only interest rate constant that was given was 0% in the sum. And I didn't give anything because this is employed. If you remember, the first or second session of mine, I only talked about the envelope frontier, because if you don't have envelope frontier, you cannot have efficient portfolio. Why? Because by definition, by all these propositions, all the efficient portfolio will be lying on this envelope portfolio. It's not possible that they lie outside. It's other way. Some of the portfolios may be inefficient and may be lying elsewhere, but the efficient portfolio will definitely lying on the envelope, and they are actually the beginning points from there. So the 0 is given, but she assumed 4, which is perfect. This is what you are supposed to do. At place of 4, you could have also assumed 6, and then the ER minus C, or this ER minus C is what you have done. So these two things, the moment you calculate these two things, then you have Z1 and Z2 calculated, and then this is calculated on the basis of this sum factor, and one divided by the other, and then this, as a final tally, all the portfolio is summing to 1. So it means you have done it right way. So you have got the X portfolio and you have got the Y portfolio, and which is what she has done here. Like the weight of X and weight of Y is done. The only thing is that this portfolio frontier is not coming efficient, because this is not at all looking. It means more and more something would have led to reduction in the standard deviation. Standard deviation is increasing. So that is possible if she would have gone this way somewhat more. But that's okay. That's okay. But then she calculated it the perfect way, and this is how it is to done. But most of you, those of you who solved, you just took 0 and did for this part ER minus C, and then solved for this Z1. So I've given you 2 marks. Those only solved for 0 and Z1. But those who didn't think of going one step beyond, I stopped there, because I assume that you you have not understood the concept of the envelope portfolio. So you require, if you have gone through the PPT, the PPT says that you need 2 envelope portfolio to create the efficient frontier, because all other portfolio will be by definition on this portfolio, or the combination of this portfolio, and that's how this was supposed to be done. So in case you are given one interest rate, so you can assume the second risk-free rate as XYZ. Anything you could have assumed 10 also, and that would have also given you a frontier, and that would have been all right. Rest all is like fine. So all of you have done most of the things right. except question number 1. And for this, I'm surprised. You know what? This question number 4 is exactly what was taught in class. So I have given marks to those who have just written like this SIM, and then written they selected these 10, and then the 11th one. So I have given marks for that also. Despite that, that is wrong. Why? You know why? Because the macro was not working. So for those of you who are saying that macro was not working, I can take the excuse provided you remember the formula. So assuming that the macro, for example, you remember today while I was solving the European call and European put, and I was not able to enter the proper formula. So I was wondering that what is happening. These Black-Scholes and binomial is just like, means I remember like anything. Means just you give me the figure and I can tell you that okay, this should be the close to this price. But this was not happening. Why? Because the most of the time that the formula that I use is BS call, which is Black-Scholes call. But for binomial, the price is binomial underscore call, American or European and then call, and which is what I was missing. And then I remember. So you can only be excused if you remember that it is a SIM. If you are using SIM single index model, so the first thing that comes is all the variance covariance, that is first 10 rows and columns, and the last one that comes is the index. If you don't know this, you'll never be able to. So some of you have what done? They have selected the entire row and column. So then you have goofed up, because if you select all the rows and columns together from MCD to GSPC, then you are not going to solve it right way. So what is expected that even if your macro is not working, if you remember the formula, then I'm willing to give you 50% marks of what is required, because ultimately you should be looking out for whether your Excel sheet is programmed with the macro. If it is not programmed, it's not your fault, because you can anyway copy it from somewhere. But you should know what is the formula. So you should know that binomial European call, binomial European put, binomial American call, binomial American put are the formula in the VBA, and what they use is the stepwise the value of up, down, interest rate, stock price, exercise price, and the number of iteration, that 3, 4, 5 or whatever. So these 6 things, if you know, and then you are 100% on, even if your macro is not working, I'm still willing to consider your answer for everything, provided you remember that this is the formula and the formula uses these steps. So this is actually expected. So just practice this, and you are done. But most of you are perfectly okay. Most of you are you have done it well. So I don't think there is any issue. So anyone who I have not told what your marks is?
So you didn't tell mine.
Means your name is
Mihir.
Mihir. So that's why I was telling you that you got only 4, because the only answer of your correct, that is macro wala. That is question number 4, where you use the single index model. You selected the column and cells in proper way. Question number 1, 2, and 3 all are incorrect. So I could not even, I have given partial marks to those who have done. But in your case, that was also not possible. So you just go and check from that. Any other person who I'm missing out?
Jaideep sir.
Yeah, Jaideep. Okay. So Jaideep, you have got Jaideep 6. Acha, by the way, I have got only your question number 4. Have you solved question 1, 2, and 3?
Yes, sir, I sent 2 Excel sheets, sir.
Oh, then I have only checked for your question number 4, which where you have given it 4. But the other thing, so maybe I need to go and look at your mail and then get back to you. So I will do one thing. I will check it right now. But I have, as I can see only one file of yours. So maybe I have saved your this macro enabled file. So maybe I'll check and then get back to you, because I thought. Or did you write? Some of you have done, you have not written your name. At some places, some of you have not written your name, so I have to go by your roll number, which is in your case 2020. and wherever it is not there, so I find it difficult what to give. So that's where. So for example, there is one person whose roll number is 2034. I don't know who it is, but name is not mentioned. So maybe if I open, then I will get to know. So Rahul Ghosh, yeah. So Rahul Ghosh, I have not done because this was not told to me. Okay, I will check for him also. Yeah, so Jaideep, I will look at your answer that you have mailed, and then I will check it and get back to you.
Okay, sir.
And I will send it today to your coordinator, and he will in turn give it to you. In those of you who have any doubt, then you can get back to me as to why the full marks was done. Because, for example, one girl is there. She is not here. I think some Mishra. Yeah, Avani Mishra is there.
No, sir.
Okay, so what Avani has done, and I want to tell her, but maybe next session we will be doing something else, and I may not get time to talk about this. What she has done, she has copied the right answer from some of her friend, and the answer is perfect. There is absolutely no problem with the answer, but I have given half marks. Why? Because I don't know whether it was done by her or not. But I also cannot say that whether she did it or not, because answers are looking perfectly all right. But when I click on the cells, शर्मा जी मैं आपको कॉल करता हूँ 2 मिनट में, मैं अभी क्लास में. So when I click on the cells, I don't see any formula. So I have given only 2 marks for that, and she has got less mark. Otherwise, she would have got maximum marks for all the questions that she attempted. So this is what I expect, that when you are writing something, when I put my cursor on that, I should be able to see what you have done. Okay, I will share with you. I think you will have a next class, right?
Yes, sir.
Yeah, so please carry on. In the next class, we'll meet, and then we'll talk about Black-Scholes model, and we'll see how we can converse Black-Scholes.
Okay, sir. Can you share this Excel file?
Yeah. So just yeah. Today's file you are talking, right?
Yes, sir.
Yeah. I'm sending it right.
Okay, sir. Thank you.
Okay, thank you.